You're standing in the checkout line, the reader beeps, and for a split second, you have that stupid little human thought. Is this going through, or is this about to wreck my day? Because when the card works, you have not actually paid the store in the final sense. The issuer paid the merchant. Now the bill is yours. And that's the whole trick. A credit card is a revolving line of credit, which means you can borrow up to a limit, pay some of it back, and borrow again without starting over. Not like a car loan or a mortgage, where the balance is supposed to move down on a fixed schedule. More like something that opens and closes based on what you've repaid. Convenient, also a little dangerous if you stop paying attention. So picture a normal month. You buy groceries, book a train ticket, maybe replace a charger because the old one finally gave up after 3 years of loyal service. Each swipe or tap adds to your balance and uses up part of your credit limit. If your limit is $5,000 and you charge $800, that does not mean the card is down $800 forever. It means you've used $800 of your available room for now, and the rest is still there until you hit the ceiling. Pay that balance down, and the room comes back. That is the revolving part. Very plain, very important. Here's where people get quietly ambushed. When the statement comes, it gives you a minimum payment. That sounds merciful. It sounds like the bank is saying, don't worry, we'll make this easy. It is easy in exactly the wrong way. The minimum keeps the account current, but it does not make the debt disappear, and it does not stop interest from building on the part you leave unpaid. So if you pay only the minimum on a balance, you are not escaping the cost. You are stretching it out and usually making it more expensive. That's the trap. And yes, the word minimum is doing a lot of PR work there. Now zoom in. If you pay the full statement balance by the due date, you generally avoid interest on purchases. That's the sweet spot. You used the bank's money for a short time, then handed it back before the meter really started running. But once you carry a balance, the debt starts behaving like debt, interest, fees, a balance that stays longer than you wanted it to. Some cards are especially sharp about this because cash advances and balance transfers can start charging interest from the transaction date, not later on. So the exact rules matter a lot. The glossy ad with the smiling person on the beach is not where you learn that part. And credit cards are not just about spending. They are also about recording behavior. Every payment, every late mark, every month you carry a balance, every month you pay on time. It all builds a credit history. Lenders look at that history and they look at your credit score when they decide whether to approve you and how much credit to give you. So the card depends on your credit file, and at the same time, it helps shape your credit file. That loop is why the system can feel a little self-referential. It is. Your use of credit becomes evidence for your future use of credit. So what does the score actually mean? It is not a moral grade. It is a prediction. A lender is trying to answer one cold, practical question. If we give this person money now, what's the chance they'll pay it back on time? That's it. Not, are they a good person? Not, did they make a thoughtful brunch decision? Just risk, translated into a number. A late payment can hurt because it tells the system something about timing. A balance that keeps drifting month after month can matter because it suggests strain. Paying on time, keeping the account in good standing, and not letting balances balloon all send a different signal. The score is memory turned into math. And memory has consequences outside the checkout lane. The number can affect what happens the next time you apply for a card, and the limit that card gets. Issuers do not hand out limits by magic. They look at income, credit history, and credit score, then decide how much they are willing to put on the line. Different issuer, different policy, different appetite for risk. The exact terms vary by issuer and product type. So you have to check how purchase interest, cash advance interest, balance transfer interest, and fees work. And debit cards? Totally different relationship. Debit pulls from money you already have in checking. Credit borrows from the issuer. That difference sounds small until you realize it changes the whole emotional atmosphere. Debit is spend your own money now. Credit is borrow now, repay later. So if you want the cleanest version of this whole thing, it is this. A credit card is a short-term loan machine with a limit and a bill. Carry a balance, and the leftover starts costing you. Miss payments, and the cost can rise fast. Not just in interest, but in the way your credit file remembers you. Credit is memory.